All right, now without further ado, let's start with the first topic of the day, and that relates to the Association of Mutual Funds in India, or AMFI, which, as you know, is the industry body that represents mutual funds in India. Now, ahead of Budget 2022, AMFI has compiled a list of, well, not demands, but a wish list of sorts. And these proposals could affect your money in a big way. So join me to talk about them in detail and to talk about the rationale behind these suggestions or these proposals. We've got the Chief Executive of AMFI, NS Venkatesh. Thank you so much, NS, for taking the time. Let's go through each of these proposals. And there are, as I understand it, 6 broad proposals that are being made. Let's talk about the first one, which I think relates to bringing about tax parity in the tax treatment for investments in different sectors. What sectors are you talking about? What instruments are you talking about?
Thanks. What we are trying to say here is that essentially we are looking at the minimum holding period of units of debt-oriented mutual funds, listed or unlisted, to qualify as a long-term capital gains asset is 36 months. However, direct investments in a listed securities such as bonds or debentures, government securities, derivatives, etc., listed on recognized stock exchanges, including zero coupon bonds, the holding period to qualify as long-term capital asset is only 12 months. So in other words, the holding period for direct investment in a listed debenture to be treated as long-term investment for capital gain tax purpose is 12 months. Whereas if the same investment is made through a debt-oriented mutual fund scheme, the period of holding is increased to 36 months to be regarded as long-term investment for capital gains tax purposes, which we believe is not fair to the mutual fund industry. So what we are trying to say is, please bring parity in tax treatment in such instances that the government says that even investment in debt-oriented mutual funds, which invest predominantly, that is more than 65% into debt, for the long-term capital gains purposes, you reduce the holding period to 1 year. In case of the zero coupon bonds, what happens is there is a revenue leakage on account of the tax arbitrage. As many HNIs are understood to have shifted their debt investment into listed zero coupon bonds, and thus managed to reduce their tax liability from peak rate of 43% to 10% under the long-term capital gains. Thus, there is a need for harmonizing the tax treatment on investments in debt-oriented mutual funds and direct investments in debt securities.
This makes a lot of sense. I think there's also been a demand for quite a while to bring about that parity. The second one within that header, so there's a sub-header within this, which talks about ULIPs and equity mutual funds, NS. Yeah. What is this relating to?
See, what happens is, in respect of the long-term capital gains arising out of the sale of listed equity shares and units of equity-oriented mutual fund schemes, they are now taxed at the rate of 10% if the long-term capital gain exceed rupees 1 lakh in a financial year. Gains up to January 31, 2018 being grandfathered. However, the proceeds from ULIPs of insurance companies, including early surrender, partial withdrawals, are exempted from income tax under Section 1010D of the Income Tax Act. If the sum assured in a life insurance policy is at least 10 times the annual premium and withdrawn after a lock-in period of 5 years. Even though if you look at the ULIPs also are investment products bundled with a little bit of insurance. And these products invest in equity stocks just like mutual funds. And they also have an additional tax advantage as a tax deduction under Section 80C of the Income Tax Act on the premium paid. So we believe that there is anomaly here. So what we are trying to say is, please bring parity in tax treatment in respect of capital gains on withdrawal of investment in ULIPs of life insurance companies and redemption of mutual fund units, so as to bring about a level playing field between ULIPs and mutual fund schemes.
Okay. And the third one relates to movement between direct and regular. So the regular is where you have you go through a broker or there is an intermediary involved, and a direct is where you go directly to a mutual fund and you choose that route to invest. So right now what happens is that if you move from one to the other within the same scheme, you have to book capital gains in that situation, or losses, but we're talking here about capital gains, right? Is there numerous instances of this happening in the industry? Is that why that is being asked for?
It happens because essentially you switch. Now you generally switch either between a regular to a direct, or from a direct to a regular. In addition to that, from a growth to a dividend option, and from a dividend option to growth, what happens is the underlying securities are not changed. It is within the same mutual fund scheme. Nothing changes. Only the scheme nomenclature changes from direct to regular, or from growth to dividend, or vice versa. But unfortunately, in the Income Tax Act, these are considered as transfer under Section 47 of the Income Tax Act 1961, and is liable to capital gains tax. So we believe, if you look at the ULIPs, there is a disparity in tax treatment on switching of investment values within a mutual fund scheme and within a ULIP scheme, although both mutual fund schemes and ULIPs invest in securities and are investment products. Because in ULIPs, if you can switch, you are allowed to switch. It is not treated as a transfer under the Income Tax Act. But in the mutual fund, it is treated as a transfer. So what we are trying to say is, please remove that anomaly.
Understood. Mr. Venkatesh, do stay with us. We would like to talk about the other proposals as well, but we have to slip into a short commercial break. Welcome back. You're watching The Money Show, and we're in conversation with NS Venkatesh, who is the Chief Executive of AMFI. NS, we were talking about the proposals. Let's get to the second one, which relates to reducing the burden for the retail investor. What are the key proposals within this?
One thing what we have asked predominantly is that please increase the limit for the withholding tax, that is the TDS, on the income distributed by the mutual funds. Currently, the TDS limit is at 5,000 rupees. So this is under Section 194K. So what we have asked is, please, can you increase that limit from the current 5,000 to 50,000 rupees? This has a reason, in the sense that the bank deposits, the interest, the TDS on the interest rates, a couple of years back has been raised from 10,000 to 40,000. So what we are trying to say is, at least bring some parity there, so that comparable instruments should have some comparable sort of TDS levels. Otherwise, it puts a lot of hardship on the small and retail investors. Though the TDS could get refunded, but then they will have to, even though they don't have an income, they will have to file a return and then await the refund to happen and all those things. So for ease of doing business, we are trying to say that kindly increase the TDS limit to 50,000, from current 5,000 to 50,000.
Okay, and there are a couple of more also. There is also an update in terms of, or request in terms of the surcharge on the dividend that's paid on equity mutual funds.
Yes,
what's the proposal there?
There, what we have asked is, the Finance Act 2020 has capped the surcharge rate on dividend income on equity shares at 15% in the hands of non-corporate taxpayers. So there is no similar capping on the rates of surcharges in respect of income distribution from equity schemes or mutual fund. Consequently, the mutual fund investors are required to pay higher surcharge at rates ranging from 25% to 37%. So what we are trying to say is, please, similar to the cap of 15% on surcharge rate on dividend income earned by non-corporate assessees, including residents and foreign portfolio investors on equity shares, the surcharge rate on income distribution on units from equity mutual funds schemes should also be capped at 15%, so that there is a parity, whether you are deriving the income from direct investment into equity or through the indirect route of investing in equity mutual funds.
Understood. So essentially, quite a few of the proposals relate to bringing parity across asset classes or modes of investment. Now, there is an interesting point here also with regard to ELSS. And I would think that with the new regime, perhaps to a certain extent, the interest in ELSS might just dwindle, but a lot of people still sticking to the old regime, NS. You're talking about multiples of 500. Are a lot of people going in for less or more than 500 multiples?
It happens in the sense that when a switch happens, let us assume that a switch happens from one of the mutual fund scheme into the ELSS scheme, which generally happens during the year-end period. So what will happen is that switch will be for an odd amount. Switch will not be in multiples of 500. So what we are trying to say is we will have to either do a partial refund above the multiples of 500 or reject the application, which is not the true spirit of the ELSS. So what we are trying to say is maybe the time has now come with the digital age coming into picture. It is better to say that, because the other mutual funds, normal mutual funds, you can invest in multiples of 1 rupee also. So what we are trying to say is with the digital there, we need to say that that 500 rupees limit should be taken away, and maybe they can put a limit saying that minimum rupees 500 investment into the ELSS scheme. Let them not talk of any multiples thereof.
Okay. Now, there are multiple suggestions that are being made in terms of strengthening the mutual fund industry. Would you like to take us through the key ones there?
Yeah, essentially what we are trying to say again in strengthening that mutual fund industry is that we are trying to say deepening of the capital markets through mutual funds. We are requesting for it, just like an ELSS scheme which is there, can they think of allowing a DLSS scheme, that is debt-linked saving scheme. So this debt-linked saving schemes can have a lock-in period of 3 years, just like the ELSS. And debt-linked saving schemes will be purely investing in the infrastructure sector of this country. So there is a felt need for investment in infrastructure sector, and this could be one way of channelizing the small savers through the capital market route for the infrastructure needs of this country, which will help the growth of the economy to a large extent and improve the infrastructure of this country. So that is one thing which we thought maybe if the finance minister can have a look at it and say that yes, just like ELSS, we will allow DLSS also to come into place. Only thing is the caveat is this particular money will be invested only in infrastructure sector. So that is one thing which we had talked to them. The second thing that we talked to the ministry is that all mutual funds should be allowed to launch pension-oriented mutual fund schemes with uniform tax treatment. Currently, the mutual funds have some pension-oriented mutual fund scheme, but it doesn't have a uniform tax treatment like an NPS or an insurance-linked pension plan. So what we are trying to say is, since pension sector needs to grow, and there are lots of people in the unorganized sector where pension is not there, it is better that the mutual funds step in, because mutual funds have shown their capability in managing the normal investments and the long-term investments, and pension is a long-term investment. So why not give that same facility to the mutual funds themselves to manage the pension or launch schemes to manage pension fund schemes. So that is one thing which we thought, so that it is on par with the national pension schemes, NPS schemes, where you get an additional 50,000 rupees as deduction under 80C.
Understood. Well, it's been an absolute pleasure speaking with you, NS, as always. Thank you so much for joining in and for giving us that perspective. I hope the Finance Minister is listening, as she normally does.
Thank you. Thank you so much.
All right, and do stay tuned. We are slipping into a short break, but on the other side, we'll speak about cryptocurrencies.